What if I told you that one of the wealthiest investors in the world started with less than $100? It's true. Warren Buffett, the Oracle of Omaha, was once a young man with a modest savings account. Yet, today he's worth over $100 billion. How did he do it? By following a strategy that anyone, even someone with no experience, can learn and use: value investing. But here's the kicker: while most people are out there chasing quick profits or the next hot stock, value investors quietly make their money by buying stocks others overlook. It's not about timing the market or getting lucky. It's about digging deeper than others and finding the hidden opportunities that are often ignored. Shocking, right? In fact, the average investor underperforms the market by almost 4% per year. Meanwhile, value investors consistently beat the odds. And get this: $1,000 invested in value stocks in 1990 would be worth over $11,000 today, compared to just $5,000 if you'd put it in a standard index fund. In this video, I'll show you how value investing can turn a small starting amount into serious wealth. No gimmicks, no shortcuts. Just the power of patience, smart choices, and learning the secrets behind undervalued stocks. Stick around, because we're about to break down how you can go from having nothing to becoming a savvy Wall Street trader. Chapter 1. The Hidden Gold Mine: Turning Scraps into Stock Market Wealth. In the world of investing, not every stock is shining with glamour. Many are overlooked, seen as scraps by most. But these undervalued stocks can hold a hidden gold mine. The key is to look for stocks that are trading below their intrinsic value. Think of it as a bargain hunt in the stock market. When the market drops or a company faces a temporary setback, it can lead to a stock price falling unfairly low. This is where you, the savvy value investor, step in. You're not looking for the next big tech sensation. Instead, you're searching for businesses with strong fundamentals, but whose stocks are priced too low. Warren Buffett, one of the most successful investors of all time, once said, "Price is what you pay, value is what you get." It's not about the short-term hype. It's about finding those hidden gems where value is waiting to be unlocked over time. The trick to finding these gems is learning to read financial statements. Look at the price-to-earnings (P/E) ratio, which shows if a stock is underpriced compared to its earnings. A low P/E might indicate a good value, but you have to dig deeper to confirm that the company has solid growth potential. Value investors also pay attention to the price-to-book (P/B) ratio. This compares a company's market value to its book value. A ratio under 1 might indicate a stock is undervalued. Moreover, keep an eye on dividend-paying stocks. Companies that pay regular dividends often have stable revenue and a commitment to return value to shareholders. Even better, these stocks can act as a buffer in tough markets. Sometimes, the best stocks are those that everyone else has forgotten about. Think about stocks that have strong brands but have been undervalued due to temporary issues like a leadership change or a legal battle. These are opportunities for those with a patient mindset. For instance, when Berkshire Hathaway bought the Washington Post in 1973, it was considered a declining company. But Buffett saw its long-term value. He believed the newspaper's business model would eventually prove profitable again, and he was right. Another statistic to remember: the average return of the S&P 500 over the past 90 years is about 9.8% per year. But value investors can often do better by finding stocks that exceed this long-term average return. Patience is key in value investing. You may need to wait for years before seeing your investment pay off. But that's the beauty of value investing. It's a slow burn, but with discipline, it can lead to massive returns. Don't rush into making decisions. Take your time to understand the fundamentals of the companies you're interested in. The market often punishes long-term value stocks in the short term, but if you're willing to hold on, you'll often be rewarded. Chapter 2. Mind over Money: The Psychology of a Value Investor. Investing isn't just about numbers, it's about mindset. As a value investor, you must manage your emotions. Markets go up, and they go down, but the key to success is staying calm through both. It's easy to panic when stocks drop. But successful value investors think differently. They see a market downturn as an opportunity, not a disaster. They understand that short-term volatility doesn't define long-term success. Buffett once said, "The stock market is a device for transferring money from the impatient to the patient." It's all about controlling your impulses. One common mistake among investors is chasing after hot stocks or trendy industries. Value investors avoid the noise. They focus on what matters, the company's fundamentals. Remember, the market is often irrational. Fear and greed can cause wild price swings. But by sticking to a disciplined, value-driven strategy, you can weather these storms and profit from them. Psychological discipline also means knowing when to sell. Many investors hold on to losing stocks hoping they will bounce back. But value investors know when to cut their losses and move on. It's about protecting your capital for better opportunities. Data shows that the average investor's return is often lower than the market's return, mainly because of emotional decision-making. The Dalbar study revealed that from 1999 to 2019, the average investor's annual return was only 2.5%, compared to the S&P 500 6.1%. The key to beating the market is less about timing the market and more about timing your mindset. If you can learn to stay cool when others panic, you'll be ahead of the game. Chapter 3. The 5-second rule. Quick tricks to spot undervalued stocks. Identifying undervalued stocks doesn't have to take hours of research. With the right strategy, you can start spotting opportunities in just seconds. Here are a few tricks to help you get started. Start with the P/E ratio. A low P/E ratio means the stock might be underpriced compared to its earnings. But don't just stop there, make sure the company has solid fundamentals. A low P/E can also indicate declining earnings. Next, look at the company's free cash flow. Companies that generate strong free cash flow can reinvest in their business, pay down debt, and return value to shareholders. Look for companies with consistent cash flow generation over time. One trick to spotting value is to focus on industry leaders. Companies that are dominant in their field but have fallen out of favor may present buying opportunities. For example, Coca-Cola, when trading at lower prices, is a value play for those with a long-term mindset. Dividend yield is another quick trick. A high dividend yield might signal a bargain if the company is stable. But if the yield is too high, it could be a red flag, especially if it's unsustainable. Lastly, check the company's debt levels. Companies with manageable debt are less risky. A strong balance sheet is a sign that the company can weather economic downturns. You can also use stock screeners, which filter stocks based on key financial metrics. With a few clicks, you can narrow down thousands of stocks to just those with the characteristics you're looking for. Chapter 4. Stock market slumps. Why they're your golden opportunity. When the stock market falls, it feels like everything is crashing. But for the value investor, it's a golden opportunity. These market slumps often lead to stocks being sold off indiscriminately, and that's when the real bargains appear. During the 2008 financial crisis, many quality companies saw their stock prices plummet. But those who had the foresight to buy stocks at these low points saw massive returns as the market recovered. Amazon, for example, traded at $50 in 2008. Today, it's worth thousands per share. Market downturns don't signal the end, they signal opportunity. But you have to be ready to take action when others are fearful. Buffett famously bought during the dot-com crash, seeing opportunity in companies that were oversold. Stock prices are often more influenced by fear and panic than by a company's actual performance. In these times, many great companies with strong fundamentals can be purchased at a steep discount. Remember, value investing isn't about chasing the next big thing. It's about finding companies that are temporarily undervalued. As the market recovers, their true value will shine through. Chapter 5. The Buffett Blueprint. How I borrowed from the masters without losing my shirt. Warren Buffett is the epitome of value investing. His strategy focuses on buying companies with a durable competitive advantage, strong management, and consistent earnings. Buffett's rule is simple: only invest in companies you understand. This means knowing the business inside and out. When he bought Coca-Cola, he knew it was a brand that would stand the test of time. The key takeaway from Buffett's approach is patience. He isn't trying to make a quick profit. He's in it for the long haul. And this mindset is what separates value investors from the rest. One of his best-known quotes is, our favorite holding period is forever. This highlights the importance of long-term investing over short-term speculation. Buffett also focuses on a company's economic moat, a term he coined to describe a company's ability to protect its profits from competitors. Strong moats are one reason companies like Apple and Google are so valuable. By applying Buffett's principles, even small investors can get access to the same kind of returns. It's about having the discipline to invest in strong companies and hold them for years, if not decades. Chapter 6. From Beginner to Wall Street. 3 steps to start your value investing journey. Starting your value investing journey doesn't require a degree in finance. In fact, you don't need much capital to begin. You just need a solid plan and the patience to follow through. Step 1. Learn the basics. Get comfortable with terms like P/E ratios, dividends, and cash flow. Read books like The Intelligent Investor and Common Stocks and Uncommon Profits to build your knowledge. Step 2. Start small. Begin with companies that you understand and trust. Maybe it's a consumer product you use daily. Buy a few shares and watch how the company performs over time. Step 3. Be patient. Your goal is long-term growth. Stay focused on the fundamentals and avoid chasing trends. If you can stick to the value investing strategy, you'll see results. As Benjamin Graham, Buffett's mentor, said, the investor's chief problem, and even his worst enemy, is likely to be himself. Control your emotions, stick to your strategy, and you can succeed. Don't forget to subscribe and hit the notification bell to stay updated with more tips on how to become a successful value investor and grow your wealth.